Hi, very good afternoon to everyone. Me and my colleague Abhishek and Harish are on today's call to take you through our monthly outlook. This time we are starting with debt market first. This is just to change the routine. If we come to slide number 4, it carries old Ajit film dialogue कि मोना डार्लिंग रॉबर्ट इसे लिक्विड ऑक्सीजन में डाल दो, लिक्विड इसे जीने नहीं देगा और ऑक्सीजन इसे मरने नहीं देगा. Somewhere interest rates are also being treated like RBI like this. एक साइड पे इन्फ्लेशन एंड बोरोइंग प्रोग्राम की फियर है, so rates are not going down. On other side, there is growth concern and monetization and intervention by RBI, which is not allowing rates to go up. We have seen 10-year yield ranging between 575 to 6 quarter in last 1 month or so. And like a pendulum, these yields are moving. If you remember in our earlier monthly presentations, we had said interest rates will decline, but not like a straight line, but like a pendulum. If you go to next slide, it shows the positive for interest rate. Current Indian banking system is hugely surplus. RBI ने छप्पर फाड़ के liquidity दी है. CRR cut, FX intervention, OMOs, all tools RBI is used to ensure that Indian banks have 6,74,000 crore of liquidity to support growth. Slide number 6 suggests factors which are constraining interest rate, which is essentially inflation. Inflation number came for July at 6.9%, but उसमें 0.9% is gold price inflation. Obviously कोई गोल्ड खाता नहीं है, सब गोल्ड इन्वेस्टमेंट करते हैं, बट अपने वहां पे गोल्ड इन्फ्लेशन में भी काउंट हो जाता है. If we remove vegetable price inflation, then core inflation is just about 4.91% in July rather than 6.9% as headlines suggest. Our feeling is that over a period of time, inflation will come further down, and that will give RBI ability to cut interest rates. Slide number 7 suggests spread between American 10-year government securities and Indian repo rate. It gives, slide number 7 please. It gives immense scope to RBI to lower 10-year interest rate or repo rate to the extent possible. There is a huge spread between our 10-year yield at 6.12% towards the close of August and US Fed rate, which is at 25 basis point. Slide number 8 suggests that the yield curve has corrected more at the short end, but not at the medium to long end. If you see 3-month rates, they have come down for 5.05 to 3.3, almost 175 basis point reduction. But the 10-year government securities is almost unchanged at 6% between March 20 and August 20. So 3 साल का spread contract हो गया 175 basis point से, but 10-year का spread hasn't contracted at all. This is also reflected into AAA rated paper, where a 1-year AAA rated paper is down 180 basis point, whereas 10-year AAA rated paper is down just about 30 basis point. Clearly, the yield curve at the 5-year level, at the 10-year level on AAA rated bonds, AA rated bond is far more attractive. If you go to slide number 9, it also shows the same scenario of steepness of yield curve in a different manner. The 10-year minus 1-year government security is today as high as 237 basis point. If you look at It was only during the crisis time of 2008-2009 where yield curve was so steep. We believe over a period of time, this yield curve, this spread should contract, and hence investing in 5-year, 10-year, 15-year GSEC will yield better return than buying 3 months, 6 months, 1 year, 3-year GSEC. Slide number 10 shows the same calculation in a different manner, where it shows how yield curve has contracted much more in 3 months, 6 months, 1 year segment of almost 200 basis point, whereas on the 5-year, 10-year segment, it has just contracted by roughly about 50, 60, 100 basis point. Slide number 11 shows that offshore investors are actually feeling more confident about Indian credit spread, and offshore borrowing by Indian corporates adjusted for forward premia is becoming cheaper compared to rupee borrowing. Slide number 12 shows spread for AAA, AA minus bonds over different point of time. In AAA segment, more money has shifted post April 2020. So the spread, which was 132 basis point in end April, has come down to 23 basis point. However, in AA plus, AA and AA minus category, spreads haven't contracted as much. AA plus is still delivering 133 basis point over GSEC. AA is delivering 266 basis point, and AA minus manufacturing company is delivering 351 basis point. Clearly, corporate spreads are trading at a higher level, and hence one can benefit by investing in corporate bond fund or credit risk fund or medium term fund. Slide number 13 shows the spread and carry around 10-year segment of the curve looks attractive. Earlier, we gave you enough data to show that 5-year, 10-year, 15-year government security looks better priced from a return point of view than 1 month, 3 months, 6 months, and 1-year government security. Slide number 14 shows two concerns on the fixed income market. One, if India gets included in global debt indices, then yields will come further down. And if there is a development on rating outlook by international rating agencies, there will be impact on our yield curve. If we are upgraded, for which chances are far lower, then our yields will come down further. If we are downgraded, for which chances are higher, then there will be short-term impact on yield from foreign institutional investors. Overall, on the fixed income side, our view reflected in slide number 15 is that 5-year, 10-year, 15-year duration GSEC is better than 1-year, 3-year GSEC. The AA plus, AA minus credit spreads are far more attractive than AAA rated papers. Keeping this in mind, we will recommend investors to invest in dynamic bond fund, in corporate bond fund, in medium term fund, or in credit risk fund. Coming to slide number 17, it shows how we have maintained quality of our portfolio. Slide number 17, please. It shows how we have maintained quality of our portfolio. In April, 93% of our portfolios was in AAA rated papers. Today, 95% of portfolio is in AAA rated papers. There were 23% allocation to AAA rated papers. In April, now it is 31%. Below AA minus was 32%, now it is 30%. Despite seeing almost 600, 700 crore of redemption, we have ensured that credit risk funds credit profile improve as promised, and today we can legitimately say hand on heart that our credit profile, which was already better in April, has further improved in the month of August. If you look at slide number 18, it shows liquidity position of our various funds. We are in an extremely comfortable liquid position. If we go to slide number 20, it talks about how dynamic bond fund has outperformed over longer period of time, and in the current environment where we believe steepness of curve will provide better return, dynamic bond fund is something which can be looked at. We also talked about how spreads have expanded in AA plus, AA minus category, and keeping that in mind, slide number 21 shows how Kotak Banking and PSU Debt Fund, Kotak Low Duration Fund, Kotak Credit Risk Fund, and Kotak Medium Term Fund could be attractive from an investment point of view. Slide number 20 gives you details about Kotak Low Duration Fund, where between April to August, we have increased exposure to higher credit quality papers. From 52% investments in AAA rated paper, we have now moved to 81%. Obviously, that comes at a price. Our YTM has come down from 9.47% to 5.18%. But at this point of time, this product has more appeal with investors. Coming to equity market, slide number 25 shows global scenario. Clearly, this is the toughest crisis which we have seen in current situation. This is worse than Great Depression of 1929, when US economy had contracted and global economy had contracted. Across the board, we are seeing countries reporting negative GDP growth. Undoubtedly, this is one of the toughest situation for global market. Slide number 26 shows how globally countries and central banks are pumping money and cutting interest rates to recover from the growth scenario, to support growth. Slide number 26, please. Slide number 26, please. I think due to some technical reasons, we are not able to move the slides. There is always connectivity issue. But if you look at the presentation which has been circulated, slide number 26 talks about how various government had provided significant support to spending, even though their revenues have contracted by increasing fiscal deficit. In Japan, 20% of GDP was provided by way of support. In US, 20% of GDP was provided by way of support. Whereas in India, we have been fairly conservative. If we go to slide number 27, clearly US bankruptcies are at 10-year high as pandemic is hitting businesses across the spectrum. Slide number 28 shows how markets are disconnected with the fundamentals. In the month of March, both fixed income and equity markets globally corrected, but by August end, both the markets had recovered their losses. Slide number 29 suggests how technology stocks have driven equity market rally, especially in Nasdaq. At the bubble of technology, media and telecom in 2000, technology sector weightage on index was about 30% plus. Now, technology sector's weightage, led by companies like Facebook, Amazon, Google, has already touched 31%. Can we try to put the presentation by making someone else host? Clearly, this technology stock rally was driven by Nasdaq whale. Apparently, SoftBank is considered as Nasdaq whale, which bought billions of dollars of stock as well as options, call options, and that resulted into massive stock covering, and that stock covering resulted into unfrenzied rally. A company like Tesla, which was available at $40 billion market cap, moved to $400 billion market cap in a space of 1 year, bulk of that getting contributed in recent weeks. Obviously, now as these call options are getting unbound, we have seen correction in technology stock. We are also seeing correction in the global equity market because of this. Slide number 31 shows how Federal Reserve has increased their balance sheet. It's now reaching almost $7 trillion from $3 trillion before the crisis. They have pumped in $4 billion through repo and through various other instruments. This money printing by Fed has resulted into expansion in equity valuation. Earlier, you were able to get 2% on 10-year US government yield. Now you are getting meager 0.5%. Might as well put that money in equity. As money supply to GDP has moved up, so has the S&P 500 trailing valuation. Slide number 33 shows the conundrum in Indian as well as global market. This is the highest ever difference between valuation of so-called growth stocks and so-called value stocks. This is determined by MSCI USA growth price to book ratio divided by MSCI USA value stocks price to book. The spread is 4.5%, which was as high as in the TMT bubble. Coming to India, on slide number 35, we see that first quarter GDP contracted by 24%. It's the highest ever drop in India's GDP in the recorded independent history, bearing agriculture, which grew by about 3.4%, and government expenditure, which grew by 16.4%. Every single sector across manufacturing and construction and services delivered negative growth. Slide number 36 suggests that yes, while first quarter GDP growth was negative and full year FY21 GDP growth will be negative, it is likely to see a good bounce in FY 2022 or calendar year 2021. We believe that somewhere, depending upon the medical situation, either March 21 quarter will see positive GDP growth or June 21 quarter will see positive GDP growth. Because of the lower base, India's GDP will climb back to higher single digit to double digit GDP growth in FY22 or calendar year 2021. One positive news among the dark clouds was PMI number on slide number 37. It came at 52 for manufacturing from the 46 in July. Slide number 38 also shows some recovery in industrial production data. It is now down 16.6% year on year in the month of June. Obviously, slide number 39 reinforces what we have been saying for some time. The Bharat or the rural India seems to be doing better than urban India. Obviously, now we have to look at medical situation in rural India. Slowly and steadily, COVID-19 has moved to interiors of India. There are many districts where COVID-19 cases have risen. And unless until medical situation is brought into control, this recovery cannot be taken for granted. The other positive for rural economy has been normal monsoon as depicted on slide number 40. The Kharif sowing is 6% higher than last year. Monsoon has filled reservoir, which is good news for Rabi season. So this year, agriculture should be supporting and helping take the recovery. Slide number 41 suggests slowly and steadily activity levels have started normalizing. Slowly and steadily, urban India has started coming to terms with COVID-19, and they are opening despite rising number of cases. Slide number 42 sums up the entire recovery through GST prism. In the month of August, GST collection was down about 14% from previous year. However, if we remove imported GST out and focus only on domestic GST, it was just down about 5% compared to previous month. If we look at the same thing in Nomura Business Resumption Index, after sharp recovery in the month of May, June, July, we seem to be stagnating in the month of August. On 2nd of August, the recovery index was roughly about 72. It has gradually inched up to 76 towards the end of August. It's still positive improvement, but clearly we need to increase the pace of resumption of economic activity. Converting this into market, on slide number 45, we can see that Nifty, especially in this current crisis, has fallen and recovered quite sharply. However, it looks like that now recovery is going to be little bit longer, as it was witnessed during 2008 global crisis, or as it was witnessed during demonetization days. Somewhere 2020 will be between what happened during 2008 subprime crisis and what happened during 2016 demonetization period. Slide number 46 puts together on a graphical manner what factors will influence market. One will be obviously valuation level. We think now valuations are fair. Second will be how US-China tension spreads out. We think they are likely to escalate in the days to come, and that will have negative impact on global equity market and probably India. US politics and election will have more bearing on US market, much less bearing on Indian market. The recovery in consumption and trade and supply chain will obviously have impact on our market. We think consumption is likely to remain stagnant. It will gradually keep on improving. COVID-19 pandemic will be the most important thing. We just hope and pray that despite rising cases, fatality rate keeps on coming down, and that will hopefully support the market. From the policy side, fiscal and monetary policy will be supportive of growth. Whatever step RBI and government takes, they will be always expecting something more. The liquidity is pretty good in equity market right now. Retail, HNI, mutual funds, insurance, FPIs, all are buyers. But certainly we have to keep a watch on the institutional flows. Overall, we believe market will fluctuate like pendulum between hope and fear, and that will be the future course of action. Slide number 47 suggests the need for medical solution. Yesterday night, there was a bad news where AstraZeneca and University of Oxford vaccine was kind of put on hold because of unexplained illness in one of the person who was tested. Today, fortunately for world, there are 5 other vaccines which are into phase 3. Apart from University of Oxford, AstraZeneca, there is hope that one of this vaccine will come handy towards third quarter of financial year 2021, which is September to December 21. Slide number 48 suggests how flows are moving to emerging markets. The S&P 500 is at a significant premium to emerging markets, and hopefully investors will start allocating money towards equity market. Fortunately for India, despite all the negative news, foreigners have continued to keep faith on India, and while they have taken money from Brazil, Philippines, Malaysia, Indonesia, Thailand, and all emerging markets, they have put money into Indian market. This is one very, very positive confirmation from the FPIs. Slide number 51 shows general market indicators. Slide number 52 shows performance of large cap, mid cap, and small cap across the period. Obviously, large caps now, courtesy rally in Nifty, has started delivering positive return from 1 month to 10 year. It is still lower compared to fixed income, but at least Nifty is now giving positive return. Nifty mid cap has negative return on a 3-year basis, just like small cap, but otherwise across the period, it has started delivering positive return, which is a positive sign. Slide number 53 shows sectoral performance. Pharma, IT, and FMCG has been big driver in calendar year 20. The biggest drop has come in private bank, real estate, and other financials. Between mid cap, large cap, small cap, by and large, correction has been almost similar, not much to choose between large, mid, and small. In the month of August, small cap and mid cap has delivered better return than large cap. And from the bottom of March 2020, now small and mid caps have started outperforming large cap, courtesy rally in July and August. Nifty is up almost 50% from bottom, mid cap is up 52%, and small cap is up 66%. We think with this rally, time has come to be neutral weight to equities. Markets are not expensive to become underweight to equities, and certainly markets are not cheap to become overweight to equities. This is time to be neutral weight to equity. Slide number 56 shows market cap to GDP ratio. At 78% market cap to GDP ratio, we are near our historical average, and hence we are recommending one to be neutral weight to equity. Slide number 57 shows price to book ratio. Again, it's almost trading at its historical average. Hence, again, recommendation to be neutral weight. If we go to slide number 58, it shows that Nifty small cap, which was underperforming Nifty 50 for a period of time between February 2018 to December 18, and had started closing the gap before correction in March, has now closed the gap, and performance of Nifty 50 and Nifty small cap is almost equivalent compared from April 2018. Slide number 59 shows that if you want, you can be marginally overweight small and mid cap or marginally underweight large cap, but by and large, your total equity allocation should be neutral. Dear investors, there are 3 guru mantras of wealth creation: regular investment, little drops of water make ocean; long-term investment, you have to wait for 12 years to get good mangoes from a mango tree; asset allocation,
don't put all eggs in one basket. People are familiar with long-term investment, but asset allocation is something which they get confused. Making money is essentially buying things which are cheap and selling which are expensive. It's so easy to say, but very difficult to do. Kotak Balance Advantage Fund allocates equity between 20% to 80% of fund, looking at the valuation. When we are allocating 20 to 40% in pure equity, we are looking at equity markets becoming expensive. When we allocate between 60 to 80%, we are looking at equity markets becoming cheap. And 40 to 60% allocation is a neutral allocation. I'm very happy to say that over last 2 years, Kotak Balance Advantage Fund has been able to capture directionally this saying of buying when things are cheap and selling when things are expensive. On 17th of Jan 2020, when Nifty touched 12,352, our pure equity allocation in Kotak Balance Advantage Fund came down to 39%. This was a signal that markets are becoming expensive and one should become marginally underweight in equity. On 24th March 2020, when Nifty bottomed at 7,801, our equity allocation touched 75%. This was a signal to be super overweight in equity. On 31st August, when Nifty is about 11,387, we are somewhere towards neutral allocation with 45% allocation to equity. Directionally, we bought equity when markets were cheap in March 20. Directionally, we sold equity when markets were becoming expensive in Jan 20. And today, we are at neutral weight. Our model of balancing our balance advantage fund has worked well in past 2 years. And I'll recommend you to look at our website and see how much equity we are allocating in our balance advantage fund to decide for you whether you should be overweight equity like in the month of March 20, or you should be underweight equity like in the month of Jan 20, or you should be neutral weight equity like we are speaking today. The second thing is to look at SIP. In the month of March, SIP number was all-time high at 8,600 crore. Today, the number has come at about 7,800 crore. And if you look at the SIP returns trajectory, in the month of Jan, the number was 16.77%. In the month of Feb, it was 15.67% for a 10-year SIP in Kotak Emerging Equity, which probably resulted into a lot of money coming into SIP. On the other hand, in the month of March, returns became from double digit to single digit at 9.24% on a 10-year SIP. The same number has now moved to 14.1% at the end of August. If you look at same data on a 1-year SIP basis, in Jan 20, 12-month SIP was giving 27% return, became minus 41% in March, and it is plus 18% in August. Clearly, there is a message to investors that you should not stop your SIP when returns have become negative or returns have become lower. In fact, lower returns are the signal for topping up SIP. If looking at March return, you had topped up SIPs in April, May, June, you would have generated far better return than what is being indicated in August. So SIP returns, please don't look at negative returns of March. In fact, that was a signal to increase or top up your SIPs. The same calculation is represented on slide number 63 for our Kotak Tech Saver Fund and slide number 64 for Kotak Equity Opportunities.
Jan returns were in double digit. March returns became single digit to negative. And in August, we have returns coming into higher single digit to double digit also. Slide number 66 also shows the same calculation, where if you miss out doing SIP when markets are cheaper and SIP returns are negative, you actually end up giving a lot of performance when market recovers. Slide number 68 shows how Kotak Balance Advantage Fund has done. It has recently completed its 2-year anniversary. It's already at its lifetime high NAV, and on a 2-year basis, it has generated better return than Nifty 50 TRI with a volatility which is lower than Nifty. When we launched Kotak Balance Advantage Fund, we had summarized it as a fund which will deliver equity minus return with debt plus volatility. I'm happy to state that on a 2-year basis, it has delivered equity plus return with debt minus volatility. Obviously, this can't be sustained forever. When there will be bull market in equity, we will deliver equity minus return, but hopefully we will maintain debt plus volatility. More importantly, it is heartening to note that in the Balance Advantage Fund category in last 12 months, total 1,200 crore flow has come, of which 876 crore, almost 75% of flow has come into Kotak Balance Advantage Fund. By far, it has become the largest inflows into Balance Advantage Fund category. We thank you for your support, and we expect it to continue in the days to come. The slide number 69 suggests Kotak Asset Allocator Fund, where we divide across debt, equity, and this asset allocator fund has also delivered better return than equity with lower volatility than equity. It has consistently added value to investors over 1 year, 3 year, and 5 year basis. And clearly, this asset allocator fund is something which you need to focus if you want to invest in a fund which is fill it, shut it, forget it. Slide number 70 suggests that for a conservative investors, Kotak Debt Hybrid Fund can also be considered. This is erstwhile monthly income plan funds. Obviously, there is no guaranteed monthly income return in this fund, and which is why it is renamed as Kotak Debt Hybrid Fund. But if you look at 1 year, 3 year, 5 year return, it has delivered decent return in tough situation. If we come to slide number 71, it was about gold call. If you remember, we gave call to invest in gold roughly at about $1,450. We are lucky that gold prices touched $2,000 and now have come down to about $1,900. We still think it is worth investing in gold, but you must keep in mind one risk factor. There is 12.5% import duty on gold in India. What you buy for $100 gold in Dubai will be 112.50 in India because of import duty. If tomorrow gold import duty is reduced to zero, rupee gold prices will drop by 12.5% overnight. Subject to this volatility, subject to this risk, we still think it is worth investing in gold, as central bankers are buying gold like they bought post 2008 crisis. There are record inflows into gold ETFs, and gold ETFs has also absorbed a lot of supply of gold, and which is where we still believe subject to this 12.5% gold import duty risk, it is worth investing in gold as a category. Please don't believe that gold prices will continue to rise in a straight line fashion. They'll go up and down. This is not 1 month, 2 month, 3 month call. After moving from $1,450 to almost $1,950, There could be some volatility in gold prices. This is a 3 to 5 year view to invest in gold, as we believe gold prices will move higher in days of high liquidity and low interest rates. There are lots of questions which investors have asked about alpha generation, and I want to portray that when you're comparing mutual funds performance vis-a-vis index, you need to keep in mind this. In fact, in the index itself, index funds are underperforming benchmark indices. If we take all Nifty index funds together, on a 1 year basis, they have underperformed Nifty 50 TRI by 1%, on a 3 year by 1.1%, and on a 5 year by 1.2%. If we come to Sensex, on a 1 year basis, index funds have underperformed Sensex by 0.7%, on a 3 year by 0.8%, and on a 5 year by 1%. One can legitimately ask question, how come index funds are underperforming Nifty 50 TRI? Well, there are various reasons why index funds and active funds are underperforming their total return index, and it's explained in slide number 78. In active funds, we can't invest more than 10% in a stock. In index fund, you can invest as per index. We all know two stocks have delivered great return in last 1, 3, 5 year, Reliance Industries Limited and HDFC Bank. HDFC Bank and Reliance Industries are upwards of 10% in Nifty. However, a fund cannot invest into Reliance Industries or HDFC Bank beyond 10%. Second, all fund keep cash to meet redemptions, and generally the return you get on cash is far lower than what you get on the equity market. In index, when a stock gets changed, like Yes Bank moved out, now some other stocks will be moving out. They are changed at the closing prices with no impact cost. But if you have to sell crores of shares, there will be a price which you have to pay to the market. Globally, total return index is compared with funds gross return, that is, expenses are added back to performance. In India, TRI is compared with net return of the fund. Finally, in active funds, mutual funds, when we receive applications below 2 lakh rupee, we give NAV when we receive the check, but the money comes over 3 days, 5 days, 7 days. And that creates an advantage to the investors, but a potential loss to the fund, as index could move by the time money comes to fund's account. Despite challenges of not able to invest like index beyond 10% in a stock, just keep the previous slide. Despite keeping cash to meet redemptions on a daily basis, despite index changes occurring without impact cost, despite charging expenses on the fund, and despite giving below 2 lakh rupee application NAV on acceptance, we have generated performance across our funds where we have delivered alpha. Kotak Small Cap Fund on a 5-year basis have delivered alpha of 7%. Kotak Emerging Equity Mid Cap Fund has delivered alpha of 4% on a 5-year basis. Kotak Equity Opportunities, a large and mid cap fund, has delivered alpha of 1.5%. Kotak Blue Chip Fund has delivered alpha of just about negative 2 basis points over 5 years. But on a 1-year basis, it is up 4% positive alpha. And Kotak Tech Saver Fund has delivered almost a 1% alpha despite all the challenges. This is net of expense return to investors compared with TRI. If we start adding fees, if we start making adjustment for cash, if we start making adjustment for 10% investment in a stock, then all these alphas will become positive. Compared to index fund, all our funds have delivered better return. Slide number 79 suggests funds which have reached their all-time high NAVs in the month of August. Balance Advantage Fund, Pioneer Fund, Balanced Fund, kind of all our equity funds have reached their lifetime high NAV, and so has host of our debt funds which have also reached their lifetime high NAV. Slide number 80 suggests our call in the past. In July 2019, we had said you should be long, mid and small cap. It did create huge underperformance in the month of March, where small and mid cap had fallen, and this call was negative. But by the grace of God, in August, we have been proven right. It took about 12 months, but this call has come correct. Gold call in the month of March was right on bank, and touch wood till today, it has worked very well for investors. In the first week of April, we had given overweight call on equity in a staggered manner. Of course, it didn't work for some part of April, but today in August, hand on heart, we can say that we gave right call for investment in equity. In April, we had also given call to invest in arbitrage fund when others were giving redemption call, and arbitrage fund performed significantly well in April and May. We had gone on our monthly product call to say you should consider investment in credit risk fund and medium term fund. It was time to take contra bet, and both these funds have delivered on an annualized basis 20% plus return since the month of May, June, July and August. This is just summary of some calls which have worked well for us, and which is why it makes sense for you to attend this call. As I mentioned, all calls don't necessarily work at all point of time, and this small cap, mid cap call was one such call. In the month of March, these returns were very, very low. But when you look at in the month of August, this call has come out quite nicely. Compared to 4% return in small cap 100 index, our fund has delivered 17% return or 16.5% return. Our mid cap fund has delivered 11.5% return versus 7.48% return in benchmark. And our large and mid cap and large cap fund has also delivered better return. Slide number 82 suggests what we are doing for our distributors. We will be now shutting our telecast on Facebook Live and will be remaining only on the Zoom call. The first and the foremost feedback we had received from our distributor community was related to better understanding of debt market. My colleague Deepak Agarwal, who is our senior fund manager in fixed income, has spent time over last 1 month to create 12 episodes in which he will give you all the learnings about the debt market. Deepak, I call him fondly Professor. He is not only a very good trader in making money, but he is also a professor mindset in explaining concepts of debt market to the investors. This 12 videos are available on our platform Prostart. I will strongly recommend all of you to go through these 12 episodes. They are episodes of about 20 to 30 minutes. This investments will make you expert on fixed income market. Slide number 84 suggests our gratitude as more than 10,000 participants, over 155 training programs have been covered on Prostart. If you haven't attended this session, you can log on to Prostart and see them. And this debt market training will also be extremely great value add. Slide number 85 shows some of the modules of Prostart. from financial planning to social media to understanding risks of mutual fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.